Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending September 9th. We had a nice rally to finish the week off, so let's dive into the charts and take a look at what we're seeing. Starting out with the S&P 500 chart on the SPY. We did see a nice bounce off of that 390 level, which was an area we called out as a possible short-term bottom area, and it looks like that stuck the landing quite nicely. And now we're seeing a nice little rally off of that. Both Wednesday, Thursday, and Friday had some pretty big green candles to finish the week out. However, we are just up against this down channel trend line, and it is so far acting as resistance. So we're going to want to see how that reacts going into Monday. It very well could be the end of the rally, and we could see it roll over from here. But if we do see the rally continue to the upside, I still think this is just a bear market bounce and won't be it'll be fairly short-lived, I believe. I'd be looking at probably, if we do see it head to the upside from here starting the week out, we'd probably be looking at a level at about 414.25, which is a Fibonacci extension level, or we'd be looking at this channel trend line here, which is also coinciding with the 200-day moving average. And so I'd be very shocked if we see this break up past those levels. And so I don't think this rally is going to have too much more legs behind it. Maybe we get another week or two of decent price action, but I think we'll likely see the market sell off fairly soon once we get to one of these three levels, and we very well might be there already if this first line of resistance is not able to be broken. So definitely be cautious. We've had a nice rally this week. A lot of sectors are showing some upside momentum just off these last few days, but I'd be very cautious going very long on a bunch of stocks unless you've got some very strong convictions or some sector strength behind it. But for the most part, I think I'd be fading this rally. Let's jump over to the triple Qs, the NASDAQ. Similar trend line here. We've got this down channel trend line that is acting as resistance. We're also up against the 50-day moving average, so we could very well see it roll over from here. But if we do see the bear market rally continue on the NASDAQ, a couple of key levels I'd be looking at possibly be right around this 21-day EMA, which is right around the 314, 315 level. And then we also have this down channel trend line since the bear market started, since the market started selling off from our previous highs, and that would put us likely right around the 320, 325 level. And I really would be fairly surprised if we saw a break above those levels. So again, on the NASDAQ, could see a little bit more move to the upside going into next week, but I think it'll be fairly short-lived on this chart as well. And then take a look at our Dow Jones Industrial Averages. We are also up against a down channel trend line that's acting as resistance so far. We're also up against the 50-day moving average. Looks like it's just barely above that right now. And so we'll need to see how price action develops going into next week as well. We could definitely roll over right from here. But if we do see some continued movement to the upside on the Dow Jones Industrial Averages, some of the key levels I'd be looking at for possible resistance, the first one being about 325. If we can get above there, then I would say about 332, and that's probably about as high as I probably expect it to go. Maybe we do go back up and retest the 200-day. We actually did get above the 200-day moving average briefly on the Dow Jones Industrial Averages, whereas the NASDAQ and S&P never did. So it is possible maybe we get a little bit more movement out of the Dow Jones Industrial Average if this bear market bounce continues. But definitely looking at those levels as a potential rollover spot on the Dow Jones Industrial Average. When we take a look at our transportation index, we are down below this Fibonacci extension level, so I don't want anything to do with transports unless I see a clear break above those levels, and would probably be looking for that as a possible area of resistance for the transport. So that's at about 14,360 on the DJT, and that's probably an area of resistance I'd be looking at for the transports to potentially roll over from there. And then take a look at our Russell 3000 chart. We did kind of expect that maybe the center channel line might be a point of resistance. It looks like it did break through that just a bit to close out the week. So maybe if this bear market rally does continue to the upside, we'll potentially maybe get back up to this down channel trend line. Also, we've got the looks like the 100-week moving average as well to contend with, and then the 50-week moving average is also very close there. So probably somewhere up in these levels if this rally does continue for a little bit. we'd maybe be looking for the Russell 3000 to top out right around 2450, or maybe as high as 2500 on the high end of things, and then I'd be expecting it to head lower from there. And then take a look at our Russell 1000, our large caps. We are below the Fibonacci extension level here at about 231, and so I'd really want to see large caps get back up above those levels and ideally get above the 50-week moving average to get really bullish on large caps. And I think that we likely will not get up above those levels. We'd probably be looking for resistance at that 231.30 level as an area where maybe the markets roll back over. If we do pierce that and get above it, then I would definitely be looking for rollover on that 50-week moving average. And then taking a look at our Russell 2000, our small caps. We do have this nice down channel trend line, but we had a pretty strong move on small caps on the week. So we'll have to see where it goes from here going into next week. We do have some resistance on this down channel trend line. We'll see if it breaks that. If it does, then I'd be looking at this 50-week moving average as our resistance level, which would put the small caps on the IWM potentially back up to as high as 200 or so before we likely roll over once again. And then taking a look at our growth versus value chart, you can see that we're in we did break this first down channel trend line, but now we are kind of started a new one, and we have not broken that yet. So I'll be watching that closely to see if growth breaks that line, and that could indicate growth is start to outperform value. But my guess is that we'll probably continue to see value outperform growth, as we are most definitely in a bear market right now. And let's go ahead and jump over to our sector review, taking a look at all the sectors that we've been tracking. This is for the last 5 trading days, so we're taking a look at just the last week here to see how things performed during this last week with a little bit of a bear market bounce. We can see on the top of the leaderboard, we've got cloud computing up almost 10%. We've got gold miners up almost 9%, which is somewhat surprising to see that sitting there. Also seeing steel up almost 8%, FinTech up about 7.5%. And then the metals and mining sector up about 7%. So those are our top 5 sectors on the week. And then when we scroll down and take a look at the bottom here, the only sector that's severely negative is natural gas. It's down over 12% on the week. So natural gas is continuing to sell off after it hit resistance on a Fibonacci extension level. And so we're looking at that one selling off quite a bit. We're also seeing emerging markets in the red, and all the rest of the sectors are in the green on the week. So overall, it's been a pretty broad-based participation rally on these different sectors. However, I do think that this is going to still be fairly short-lived, so I would advise some caution going super long on a bunch of different stocks right now. And then jumping over to the oil chart, taking a look at our U.S. oil barrel pricing. We talked about how we have been in this upward channel for quite some time, really since the COVID crash. And we did finally just break and close below those levels for the first time since the COVID bottom. And I felt like that was a pretty significant development for a possible trend change in oil. And then going into this week, we did actually see it sell off even further. And it actually broke down below the 85 level and got as low as about 81 per barrel before it had a bit of a rally back up and closed the week up above the 85 level. If you are bearish on oil, I'd be looking for a nice close below the 85 level, and if we do get that, then I think there's a good chance we go back down to the 200-week moving average, which would probably put our U.S. oil prices somewhere in the neighborhood of about $62 to $67 per barrel, and I'd be looking at that for a possible floor in the oil barrel prices. And if we do get down to those lows, then that might be a really good opportunity to re-enter some long positions on the energy trades. But for now, I'm being very cautious with the energy trades, as it looks like things could be selling off in oil. So good news for the gas pump potentially, but not so much for being super long the energy space right now. And then take a look at our commodities, our CRB index. We were suspecting this thing would get back down to the bottom of this channel here, and it looks like it did, and it actually acted as resistance and bounced off of that pretty aggressively on the week. Also really close to that 50-week moving average, not quite there, but pretty close. And so it looks like so far this down channel trend line is intact, acting as resistance. If we do see the CRB index break below this channel trend line, which will also be below the 50-week moving average, I would say that'd be a pretty massive development, and very much likely would be a nice indicator that inflation might be rolling over even better than some suspect, because if we do see the CRB index break below that trend that's been in place since the COVID crash, I think that'd be a pretty interesting development for the commodity space as well, and probably be good news on the inflation narrative. And then jumping over to our consumer discretionary versus consumer staples, we did see a big move in consumer discretionary as opposed to consumer staples on the week, so there was a lot more risk on appetite due to this bear market bounce, but I wouldn't be surprised if that was more of just a short squeeze, as there was a ton of protection being put on the markets. And again, I'm still exercising a lot of caution on getting super long on too many sectors or too many stocks right now, as I think there's still a lot of risk in the market for a sell-off. And then jumping over to our VEU, the Vanguard All-World ex-US Index. So this is our global markets minus the United States. We can see it looks like we're putting in what might be a short-term double bottom at that 4750 level, and we'll see where we go from here on that. Maybe we get back up to this 5220 level, and that might act as resistance, and then we maybe roll over from there. But I think looks like we'll probably be between this 4750 and 5220 level until we see a definitive break one way or the other. But I still do think we are headed to the downside. We've got a pretty clear down channel trend line here, and until we see a real definitive break for that, then I think the bias is still to the downside for the global markets as well. And then when we take a look at it on relative terms, take a look at the emerging markets divided by the S&P 500, we can actually see that while the global markets had a fairly strong week, on relative terms compared to the US, it actually was down, and we can see that we're still in this very strong down channel trend on emerging markets relative to the US markets, and so emerging markets are still looking pretty weak compared to the United States. And then taking a look at our high yield corporate bond ETF, the HYG. We've been talking about the 7511 level is a really key level that has only been broken a few times really in the history of this chart. And we did break that level once again for the second time this year. But then this week we did see a nice rally back up above that 7511 level. I think probably when the markets sell off again, we'll likely see HYG below that 75 level, and that'll probably also coincide with the market selling off as well. And when we look at the HYG on relative terms compared to corporate bond or traditional bonds, we can see that we're still kind of in this trading range here, and so we'll also likely see a breakdown on this and potentially to the downside when the markets really start to sell off, but we're not there quite yet. And then taking a look at our metals, starting out with gold. Looks like gold is bouncing off of the 200-week moving average. And so if you're a long-term gold bull and you're looking for a good opportunity to put a long position on, this could be a good spot. As long as we stay above that 200-week moving average, that could be a pretty nice entry point for a long-term position on gold. If we do see gold fall below that 200-week moving average, I would, if you're just trading the GLD, I'd probably take that trade off. But it does look like this could be some potential support forming, and while it could sit there for quite some time, it may not be a very good short-term trade. But if you're more of a long-term trader, this could be a decent entry level on the GLD. And then taking a look at our silver, the SLV chart. So our weekly chart on the silver price, we are sitting at about just over $17 per ounce. We did have a bounce off of about a $16 level the previous week, so we did see a decent bounce off of those levels. But as far as trading silver, I'd really want to see us get back up above that 200-week moving average. If I was going to go long on silver, which is more up right around the $19 an ounce or so. So I'd really want to see silver get back above and see some price action close and hold support above that 200-week moving average before I was looking for any longs in silver. And let's jump over to our 2-year yields. We are sitting at about almost 3.6% on the 2-year, so we saw a pretty strong move to the upside on our 2-year yields. Taking a look at our 10-year, we also saw a pretty strong move to the upside on those as well, sitting at about 3.3% on the 10-year. The next target, I think, to the upside on the 10-year is probably getting back up to this 3.5 level. And if we do see a break above those levels, it seems like there's a pretty decent chance these days that we might be looking at a 4% 10-year. So we'll be keeping a close eye on that. But somewhere probably between 3.5% to 4%, I think, is some potential tops on the 10-year. Obviously, that'll depend on the inflation narrative and how the CPI numbers and everything else are coming in, but it's definitely looking like, I think, a 4% 10-year could be in the cards. And then taking a look at our 30-year, we are sitting at just under 3.5%. We got a little bit higher than we had previously back in June when we had peaked out on the 30-year close to 3.5. But we did pull back, finishing the week out just below that. So if we do see a clear break above that 3.5, then I think we're likely heading higher as well on the 30-year. And then take a look at our yield curve, our 10s minus 2s. We're still in negative territory. We're at about negative 0.25%. It is up quite a bit since our June or August lows rather, where we were at a negative 50%, which was in a very extreme reading. But we are still in the negative, and we still have not broken this down channel trend line. So I would think that these numbers are probably going to continue to get worse unless we see a real definitive break above this trend line. And then taking a look at our VIX, our volatility index is now down below 23, so it closed out the week at about 22.7. And that's been a bit of a trend change since the beginning of the week. We started the week above 25, and 25 is definitely a bit more of an elevated level, more fear in the markets. When we get up to 30, there's definitely some really elevated fear in the markets. So the fact that we have broke down below those levels and we've seen a bit of a rally in the markets these last 3 days as the VIX has declined, as well as we've seen a bit of a decline in the dollar, which we'll get to next. There's looking like there potentially could be some a little bit more legs to this bounce. Maybe we do break those down channel trend lines in those major indices, and maybe we do see a little bit more movement to the upside before a rollover. But either way, I'd still be very cautious because I just don't think this is going to be a long sustained rally. And then taking a look at our dollar chart, the DXY. This is also another reason why I don't think the rally is going to be super sustained, is taking a look at some Elliott wave analysis for the DXY on the US dollar. It looks like we just had a wave 1 to the upside, and we are doing a bit of a wave 2 correction right now. However, this is not going to be a massive drawdown, it doesn't look like, and so I think we'll potentially see a little bit more selling pressure on the dollar. Maybe we see it get back down to the 107.70 level or so. But I think we'll probably bottom out right around those levels. That's also likely going to coincide with our 50-day moving average. So I think we'll probably bounce around those levels and then take off to the upside from there. And so once we do see this bit of a correction finish off, then we'll likely have a wave 3 even higher, which would likely put the DXY all the way up to about 117, almost 118 on the DXY. And so I think this next leg higher on the dollar that's going to be coming fairly soon will probably coincide with the next sell-off in the markets, as well as the next sell-off in crypto. And so that's why I've been saying for quite a while now that the DXY I think is one of the most important charts in the market right now to keep your eye on. They tend to be fairly inversely correlated for both the stock market as well as crypto. I'd say the correlation is even tighter with the crypto space, and we can see even that this last 3 days where we had a decline in the dollar, that also coincided with those 3 days on the rally in the market, as well as we saw a little bit of a rally in Bitcoin as well. So definitely keep your eye on the dollar. I think it's a really important chart to give you some sort of indication as to where the broad markets are heading from here. And it looks to me like the dollar is still going to continue to rise. Using Elliott wave, this wave 3 wouldn't even be the top of the cycle. We'd have a wave 4 correction, then a fifth wave higher for further upside move in the dollar. So until we see the dollar definitively roll over, I think there's going to continue to be more pain in the markets for both crypto and for the stock market. So let's go ahead and close it out, taking a look at a few of our crypto charts. We'll start with Bitcoin. Bitcoin has been doing a pretty nice bottoming process where this $19,000 level has acted as very strong resistance. We've seen it hit 1, 2, 3, now 4 different times. Granted, the 4th time it did sort of fail briefly, but then it whipsawed right back up above the next day. And so this $19,000 level has been a very strong support level for Bitcoin, going all the way back to June of this year. And so for now, it really looks to me like Bitcoin is stuck in a trading range between about 19,000 and about 24,000. So for me, that's really not much to trade off of or get super excited about. I'd really want to see Bitcoin drop below this $19,000 level before I go short again, or I'd want to be looking for a breakout above that $25,000 level if I was getting excited about getting into any longs. So I think most likely we'll just see Bitcoin kind of chop around in this $19,000 to $25,000 level, and this is looking also like a wave 4 correction that we're in right now before we hit a fifth wave to the downside further. So it's looking to me like we might be looking at potentially a 12,000 or so bottom on Bitcoin. That's the anchored VWAP from the previous cycle low. It also lines up with some Elliott wave math to put us right around that similar price target. So I'm definitely looking for a potential bottom in Bitcoin right around that $12,000 level, and definitely looking for it to break down below this 19K. But for now, we're still kind of chopping around in some sideways price action. And we'll finish it up with some the Ethereum chart, taking a look at that. Obviously a lot of news on Ethereum with the changes going from proof of work to proof of stake. And so we're taking a look at the Ethereum chart where we've seen some price action there where it's been moving to the upside a bit since about the end of August. It has bounced off about 1400 level, and we're now sitting at about 1700. Could potentially see Ethereum break out further. Maybe we get all the way back up to this 200-day moving average, which would get Ethereum back up to about the 2000, 2100 level. But I'd really be looking for a rollover from there. So if you're wanting to be a little more aggressive and try to capture that's about 15-20% left of this move, that's potential there, you could put a trade on here and look for that kind of 15-20% upside. For me, I'm probably just going to sit back and watch the price action develop. And just kind of keep my eye on this one. But if you are looking for a trade in Ethereum, there could be some momentum to the upside, maybe up to that 2000, 2100 level, but then I'd be looking for it to roll over from there. If we do get to that 2100 level and we see a rollover from there, I think that'd be a great opportunity to start shorting Ethereum, because we'll likely roll over and head back down to the previous lows, if not lower, which could get us all the way back down to about 800-900 on Ethereum. Thanks for tuning in this week. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And make sure to like and share this video, and we will see you next time.